Hello, and welcome to our first quarter 2018 strategy review, which was held here in this room on Wednesday, December 20th, the day that the tax bill was passed. And believe me, we will not be ignoring that through our presentation today. But first, let me introduce who was with me. To my right, Len Skena, CFO and Vice President, and to my left, Bob Toomey, Vice President and Director of Research. In addition, Nat Bowie, our paraplanner, was in attendance, and Scott Schill, our legal advisor, was also in attendance. And on the phone, we had Art Nunes of Northwest Asset Management contributing as well. So we had a very, very good group of people, and we had some extremely good interchange. To the basic interchange, of course, we covered all the areas that we normally do, but the tax bill was certainly high on our agenda, and frankly, all of us were scrambling to figure out what was in the final tax bill, because remember, it had just been passed, and it was going to be implemented, but many questions were there. To the question of what does this do for business, I think it's pretty clear. It is a very favorable tax bill towards business, and as we'll go through in each one of the sectors, there seems to be positives in many, many areas, increases in GDP, increases in payouts, all kinds of positives that will probably be good for stocks and probably therefore good for the markets. As far as individuals go, there's been a lot of information, but it's been somewhat confusing. The individuals are definitely getting a reduction in their tax rate, similar to the corporate, but not nearly as large. The number that's ballyhooed around is 39.6, dropping to 37. Frankly, looking at that number, however, there are also changes in not the brackets themselves, but in the ranges within the brackets. So there are bigger differences than you might initially expect. We will be maybe calculating those and commenting on those later. The other big decision is an increase in the standard deduction. And it has gone up significantly to $24,400. And on the other hand, they have eliminated or restricted other potential deductions. So the question for individuals is there a reduction in taxes? And the answer seems to be, for the greater majority, yes. However, it will not affect everybody in an equal manner. One of the changes that we have to take into consideration is changes that affect how certain deductions, which appear at the over 2% number, like our fees, are affected by those changes. Affects not only fees such as ours, but also accountants, attorneys for planning, etc. And that appears to be eliminated. We have taken, and you will see that in your reviews, a step to increase our payments for the end of the year. So in other words, we are going to collect your fees that would normally be collected in January in December, where they are clearly still deductible. We hope that everyone agrees with that. We certainly feel that it is better to take the deduction than look at it later. Okay, with that, I'd like to throw it over to Bob to talk about the economic outlooks.
Thanks a lot, Stan. So in a word, I would say that the U.S. economy is generally doing quite well, as I'm sure many of you are aware. You're hearing about this in the news. If you watch the news or care about that, as we do. But it looks as though U.S. GDP this year will be running just under 3%. We're estimating GDP for the full year to be about 2.8%. Next year, we think GDP can actually accelerate somewhat to the 3 to 3.5% range. And part of that does have to do with the tax bill that Stan mentioned. So if we look at the various components of the economy, employment is strong, corporate profits are strong and appear to be poised to accelerate. Capital spending is also strong, and that appears poised to accelerate. And consumer spending is very strong as well. So the economy is really hitting on all cylinders right now. So if we look into 2018, as Stan mentioned, the tax bill does have a number of positives with respect to the corporate sector that I think are positive for the stock market. First of all, the corporate tax rate is dropped by 14% to 21%. We've seen analysts beginning to raise their forward earnings estimates for 2018. It's positive for GDP. In fact, one analysis we saw from J.P. Morgan was that the tax bill, between the benefits to the consumer and the corporate sector, could add upwards of 1.5% to GDP in 2018 and 2019. So all of this presents a positive foundation for profits, and it again should be positive for stocks. Now, in that case, there are some offsets that we do have to think about. With an accelerating economy, there is a concern that inflation could also accelerate. And inflation and rising interest rates tend to be negative for financial assets. So we have to watch that carefully. Another risk really is if the Federal Reserve becomes more aggressive than we now expect. I think Len's going to talk about that a little bit in a minute, but we think the Fed will remain fairly moderate, but there is a risk that if the economy accelerates and inflation accelerates, they could become more aggressive, which would be negative for stocks. And finally, valuations, as you've heard me mention before, valuations are elevated. They're not what I would call nosebleed levels, but at 18.5 times forward earnings, we're not looking at a cheap market anymore. And so we have to bear that in mind as well. So with that, I would like to turn it over to Len, who's going to talk about fixed income.
Thank you, Bob. As Bob mentioned, the Fed is in a policy right now where they are raising interest rates, and we don't expect that to be very aggressive. We expect them to continue to be measured in the way that they do that. There are some things that can possibly change that. Higher inflation could enter into the equation and possibly force them to do a few things that we really aren't expecting them to do. But right now, the Fed has been pretty transparent that they want to raise rates at a certain rate, and they are expected, at least by us, to continue to do it in a very measured way. One of the things we expect to constrain them is the idea that the lower duration interest rates are the ones that get most affected right now when they're raising them, and the longer term rates are staying basically where they're at. So as they continue to raise those rates, we're going to continue to see a flattening of the yield curve. The Fed does not want to raise rates to the point where the yield curve goes beyond flat and actually becomes inverted. That typically leads to a recession, and it is not something that the Fed wants to mess with. So we fully expect them to stay in a very controlled manner and very deliberately raise rates, but we do expect them to go up from where they are. It really isn't much of a change in the way that we've been viewing the interest rate situation for a while. And to that end, we really haven't changed how we're allocating our the bond portfolio very much at all at this point. Really what we are doing is continuing to favor the short end. We're leaning a little bit more on the long end and barbelling more than we had been before, but for the most part, we're skewing things towards the short end, and we're going to continue to do that. The one change that we did make into the portfolio allocation with respect to bonds is we eliminated the one actively managed fund that we've had for a while in the intermediate area. We have been closely watching that. We've been making sure that they're continuing to add value. And recently we feel that there's just not sufficient additional value in that fund to justify the higher cost. And so we've eliminated that from the portfolio, and we're going with just a straight intermediate term corporate index fund there. With that, I'd like to turn it over to Stan to talk about REITs.
Thanks, Len. REITs are always tend to fall in my direction, I think primarily because REITs have been such a stalwart position in the firm virtually since its beginning. Many of you that have been with us for that period of time recognize that we were investing in REITs when most people didn't even know what a REIT was, much less used it as an investment vehicle. But at any rate, they've been very, very excellent investments. They have supplied and continue to supply a very high rate of dividend because they do pass through and must pass through 95% of all their income. However, at this meeting, we specifically were concerned about the fact that REITs invest, as we invest in them, in three primary areas. One of them is large apartment buildings. One of them is office buildings. But the third is in large shopping centers. As we evaluated our current holdings, we were a bit concerned because of the move for shopping centers to be reduced in their exposure because of the internet play. We were concerned that maybe we wanted to reduce our holdings, at least in the shopping center area. We chose to do that by reducing our holdings in our main VNQ, which is the Vanguard REIT, and diversify that so that we are buying another REIT that invests primarily in medical properties and another REIT that invests primarily in industrial properties. By doing this, we are reducing our exposure to shopping centers, but still maintaining the high dividend return that we get from the REIT portfolio, and we still very much like that facet, and we like that part of that investment. Now I'd like to turn it over to Len to talk about international.
Thank you, Stan. The international area has been one that has been performing well recently, and we expect that to continue. In fact, looking forward, we expect it to perform even better than the U.S. area in the coming year, and it is one that we're overweighting a little bit. The areas that we're emphasizing continue to be the developed economies, and we're putting a particular emphasis right now on Europe, as we have been for a while. Europe remains a better value in many places than the United States does, and we're expecting to take advantage of that and to see our allocation hopefully benefit by putting a little bit more of it in the European area. We are not at this time considering going into any of the emerging markets. That's something we talked about. We've been kicking it around for a while, but we still don't quite feel that this is the time that we feel comfortable putting any of our allocation there. And so we're going to continue to remain focused primarily and actually exclusively at this point on the developed economies. With that, I'd like to turn it over to Bob, though, to talk about changes in our portfolio holdings in other areas.
Great, thanks so much, Len. So Stan and Len have both talked a little bit about some of the changes that we've made, particularly in the REIT area. I would just add to that we did diversify away a little bit from VNQ and added a position in medical REITs and also in industrial REITs, which both have very good long-term prospects, as you can imagine. We increased our exposure in small caps, and the reason for that is because small cap stocks should benefit more from the tax bill because they generally have higher tax rates and generally do not have as much international exposure, which means their effective tax rates tend to be higher. So they will benefit somewhat more. We maintained our exposure in healthcare and financials. We believe both those areas remain very good long-term investments. The financials in particular should benefit from rising interest rates as they are disintermediation vehicles, if you will. Rising rates should help their profits. And the healthcare area remains a strong area, we believe, because of the demographic outlook and the good prospects for growth in healthcare in general. We maintained our position in home builders. We've had a very nice gain in that position, but we talked about that at length and we believe that the underlying fundamentals for home builders continue to remain positive. They benefit from a strong consumer, and we believe that the elements for continued home purchasing remain positive. Finally, we did increase our exposure slightly in the natural resource area because we believe there probably is going to be some increase in inflation in 2018. Natural resources like energy, metals, and those areas benefit from rising inflation and also stronger capital spending, which we expect in 2018. So with that wrap up, I will turn it back to Stan for closing comments.
Thanks, Bob. And I would like to just comment on the fact that we are completing one of the best market years that we've had in a very, very long time. And as we do that, we have nice profits throughout our portfolio. As we make these adjustments that we've been talking about, therefore, we have decided that we will postpone our actual implementation, therefore putting those profits, for instance, in the VNQ and the REIT, that we will be accepting into 2018 rather than paying them in 2017. On the other hand, the removal of the managed asset in bonds was at a small loss, so we did decide to take that loss. So you may see a bit more capital on your statements at year end, and we'll look forward to the next change coming in January. That, together with the changes that we talked about collecting fees early and making any other adjustments that we can as a tax benefit for the end of the year, you can be sure that we will be doing. With that, I would like to close, but I feel uncomfortable not mentioning Bitcoins. I'm mentioning it at the end because the fellows may decide to take it out, and therefore they can. But Bitcoins did turn out to be probably more of a discussion than we really wanted to between everybody here. And the question really is, what is it? And the answer seems to be that it is a highly speculative form of investment, one that we as a firm would never get involved in, and actually by contract cannot get involved in. But we don't want to ignore it because, as they said on CNBC this morning, it is in the institutional lexicon now. And by the way, if you didn't notice, it dropped 1/3 in value today. With that, again, thanks for watching, and see you next quarter.